How's it going, friends and family? My name is Amos, and if you're anything like me, you're always eyeballing and you're looking for stocks to potentially add to your portfolio. So if you find one, you can add it right next to your 5 shares of Ford Motors and the 3 shares of that stupid speculative biotech stock that your coworker told you about that you regret investing into, but you don't want to sell at a loss, so you're just holding on to it. But I digress. When I'm at a crossroads of whether or not I want to invest into a stock, it's gonna sound really cheesy, but I refer to my own slide deck that I made. It's about a couple dozen slides, and I go through it and I try to answer the questions to see whether or not it makes sense on paper to invest into that business, to become a part share owner of that company. Like right now in this slide, the type of business I like are compounders. Number one, characterized by monopolistic behavior and practices, meaning whatever that they do in their domain, territory, or sector, they establish dominance. Nobody can come near them because of their economic moat, their competitive advantages, or whatever that they do is the X factor. It's so much better than the competition. Number 2 is like what? Good management team, and this one's controversial. I actually like stock-based compensation. Yes, it dilutes and eats away at the free cash flow, but as I wrote right here, stock-based compensation is good to see because they have incentives to do their best. The leadership team, they don't get paid unless the stock goes up. So it aligns their interests with that of the shareholders. We can all mutually win. And then some examples I list right here of restaurants, McDonald's versus Red Robin. I would argue McDonald's is best in class, whereas Red Robin, the place of the bottomless basket fries, they're struggling right now. They might even shut doors any second. And then when we think about the utility sector, NextEra Energy, in my opinion, best in class, versus the one that's based in the Bay Area in California, not so good. So I guess the point that I'm trying to make is I go slide after slide after slide to try to figure out whether or not the company, objectively, the numbers and data and metrics and fundamentals, does it make sense, or is this an emotionally driven decision that I'm contemplating, right? And if you're interested at all, I'll post the updated version of this slide deck up on the Patreon so you can have a look at it. I think it's literally a 400-page investing book condensed into like 25, 30 slides. I think it's worth your time. Now, having said that, something about me is dividend growth investing probably makes up about 90% of my decision-making process and strategy when it comes to investing. I like companies that are able to grow and increase their dividend payouts year over year at a rate that's better than the historical rate of inflation, but I also do allocate a small amount of capital towards growth stocks and income ETFs, but I don't go gung-ho into either one of those directions, just a little fun money. Dividend growth investing is what I believe in, and it's how I seem to do okay in the stock market. So in this video, I'm gonna be sharing with you how I beat the stock market by investing into dividend compounders with cheese. We'll be defining what exactly that means. It's the name of this channel, and we'll be using Alphabet as an example. I'll be referring to them as Google. Alphabet is the parent company. Their website is XYZ. Kind of funny, but I think they're pretty synonymous with Google. So if that sounds good, let's go ahead and get into it. Now, between you and me, a company, a business, a stock that I truly believe in, and I put my money where my mouth is, and I put thousands of dollars into in 2025, was Google. Now, I have receipts on my YouTube channel. You can pause this video, go over to my channel, click on the videos tab, and look at how many videos I uploaded about Google, talking about how undervalued and how much upside there is to Google. And I say all of that because I have been buying the dip into Google for the past like 2.5, 3 years. I've been holding on to Google since 2018, 2019, and I've just been dollar cost averaging whenever there was any negative sentiment or headlines in the news that's like, oh, Google's gonna be broken up, they're a monopoly, AI is gonna make their search line of business irrelevant. I heard all of that and I was like, dude, it doesn't make sense because on paper and what they're establishing and the numbers that they're generating says otherwise. Case in point, if you take a look at your screen right now, if we look at it from the past 1 year, yes, they did reach a high of about like $200 back in February, but for the most part in 2025, they were sold off, beaten up, and considered ugly, hairy trash. Okay, I think back in April, they reached a low of about like what, $140 a share. Yes, I did pick up shares of Google on that day. But the thing is, even though the stock market treats Google so unfavorably, especially in the first 3 quarters of 2025, I would argue that everyone, including the 49er fans, even though their IQ is a little bit lower, they realize that Google is a high-quality compounder. We all get it. The retail investors, amateur investors like you and I, we all know that they're a beautiful stock. However, their stock price was suppressed for the longest time because of pending regulatory outcomes. Yes, they were being probed by the government for their monopolistic and antitrust practices. But friends and families, there has been an update to their antitrust case as of this past week. And I'm going to refer to the notes that I wrote down on this piece of paper. Yes, we're going back in time, old school, okay? So Alphabet keeps Chrome, but no more exclusive contracts, meaning the various phone manufacturers around the world, they no longer have to only install Google apps onto their device and only use said Google apps. Now there's room for them to install whatever they want to on their device and operating system. And also Google is now no longer allowed to do bundling. Previously, a device had to accept Google Search as the default option to get access to the entire Android ecosystem. So Google, all right, I'll agree. They were bullying the phone manufacturers to being like, hey, you're gonna set Google Search to be the primary, the default option, otherwise you can't use our services. That's a little messed up. I agree right there. However, the point is they no longer can do any of that. And also, this is the crazy part. Google can now continue to pay Apple billions of dollars every year so that Google Search is the default search engine when you open up Safari. So I guess the judge was like, all right, you know what? They're paying them in order for that to happen. So we'll deem it okay. And so consequently, as you can see on your screen right now, right before that news broke out, Google was what, roughly 206, 208 a share, and now they're 232 a share. The stock market loved the outcome of the judge's ruling, but also a parallel beneficiary was Apple. Past 5 days, they're also up by 3%. They were previously 228 and now they're 239. They both win because Apple gets to keep their reoccurring revenue stream from Google so that Google Search can be the default on Safari, but also Google is allowed to have a monopoly on iPhones. Yes, if you do have an iPhone like I do, I don't know where my phone is. Dude, I lose my phone like 5 or 6 times a day. I have ADHD, it sucks. Just because you have an iPhone does not mean you have to use Google Search. I know there's people out here that prefer to use Bing. Dude, I love Microsoft. I think they're a high quality dividend compounder, but my goodness does Bing make me so frustrated. It is by far one of the worst search engines. So yes, iPhone people could use another search engine, but why? I feel like Google is best in class. And another outcome of that ruling is that Google has to share search data with the competitors. And I feel like that's a heavy blow. For me, I don't really know how to interpret or receive that yet because I feel like having that proprietary data on all of the various users on Gmail, YouTube, and whatnot, Google has a vault of user data that's really valuable to potential advertisers and clients. But now that they have to share that with their competitors, rivals, and peers, I'm like, that's going to be unfortunate for them. Hopefully it doesn't erode at their economic moat. I guess as they say, only time will tell. So that's why Google, as of right now, is currently trading at a valuation that makes more sense to me. Now they're at a 24.7. For the longest time in 2025, dude, they were at a teen-digit number, like 14, 15. And it makes absolutely no sense. Reason being is now we're going to define what exactly is a dividend compounder with cheese and why is it that I invest into that category and class of stocks. So as you can see on your screen right now, if we just consider their share price history, not baking in the dividends that are really small, we max it out. Since they IPO'd on the stock market in 2004, they're up by 4,500%. If we just do 5 years, we're talking about 185%. So a compounder is a high quality business that's able to compound your initial investment. So if you invested like $100 into Google, eventually it becomes $200 by merit of their performance through their operations and them kicking booty. So if they do well as a business, their stock price goes up and your initial investment compounds. So that's the compounder ingredient. But if we jump on over and take a look at some of their metrics and fundamentals, the first one that I want to take a look at is their revenue. This is what we investors refer to as the top line. And objectively, this is how we gauge whether or not a company is growing. Because if their gross sales are not increasing year over year, then inherently, by definition, that company is not growing, correct? And that's why when it comes to the earnings season, which happens like every 3 months for every company that's publicly listed on the stock market, we refer to the top line and the bottom line. I'm getting ahead of myself, but the top line is that freaking crucial and important. Now, when you take into account Google, in 2015, friends and family, they generated $74.9 billion of revenue. And as we fast forward throughout the years, just look at this beautiful, compounding, reliable consistency growth. Right now, the trailing 12 months or the past 1 year, we're talking about $371 billion of revenue. But it's not enough to just post stellar and beautiful billions of dollars of revenue. You also need to see the year-over-year change be positive and in the green and at a rate that makes your nipples perky. Like right now, I have an undershirt so you can't see it, but my nipples are like rock hard. You can literally shred ice right now because year over year, take a look at the growth of their revenue. 2023 to 2024, we're talking about a growth of 13.8% year over year. Dude, that's absolutely bananas. And if we consider the past 12 months in comparison to fiscal year 2024, then it's a growth of 13% again. So metric number one, rock solid, beautiful Viagra. If we scroll on down, the next thing that I like to look at on the income statement is their bottom line. This is also referred to as the profits, the net income, also known as the earnings, okay? And when you take a look at their bottom line, what are the profits that are left over going into their pockets after funding for the overhead costs? Take a look at this. It is just as juicy and as beautiful as the revenue. It's consistent and it's going up into the right time and time again. I'm not twisting the numbers. This is objectively stated, $115 billion of profits. Are you freaking kidding me? After taking into account the SG&A, how much you pay your employees, after taking into account the costs to run your data servers, the warehouses, the insurance costs for all of your employees, et cetera, $115 billion. You tell me, is Google not high quality? And that's why when I saw their stock price being suppressed for the past year and a half because of the pending regulatory probing, I was like, dude, it makes no sense because on paper, it looks really magnificent, really beautiful. Case in point, that's exactly why I poured a third of my IRA's capital into United Health Group. Go watch that video if you want to understand why I'm invested into United Health. But anyways, it's not enough to just look at their net income. You also want to break it down to the share level. That way you can see the quality of their earnings, of their profits, of their net income, of their bottom line. Because if the company issues way too many shares and dilutes the shareholders like you and I, then the quality of their bottom line is eroded. Does that make sense? And to do that, it's also listed right there. Shares outstanding, there's 12.3 billion shares outstanding. So you're gonna divide the net income to the shares outstanding, and that gives you the earnings per share. So what I see on the screen right now is $9.39. That's the profits per share outstanding. Per share you own in your portfolio, the profits is $9.39. By the way, if you like this style of teaching or content, I actually made a dedicated series where I break down the financial statements, including the balance sheet and the income statement. I'm still working on the cash flow one. Go and watch that series if you think you're learning a thing or two right now. So what I like to see is that their profits per share is growing and is consistent year over year. And besides 2022, one could argue that the bottom line for Google looks phenomenal and fantastic, because what I have seen in the stock market after evaluating and analyzing thousands of companies at this point, usually the earnings per share, the growth percentage change is usually like 3, maybe 4%. And that's considered a success. But for Google, they're executing 38% growth year over year, and then 34% year over year. Like, that's phenomenal. And mind you, I'm turning a blind eye to 2021, where it increased by 91%, and of course 2018, 142% year over year. Phenomenal, fantastic, beautiful. And if we jump on over to the cash flow statement and we take a look at their free cash flow, this is a good way to understand how much cash is left over after you fund the operations to run the business itself. They have $66.7 billion of free cash flow. Dude, that is absolutely bonkers. And just like the earnings per share, I personally like to break it down to a per share level so that you can see the quality behind the metric itself. And also, that way you can compare it to another potential investment like Google versus Nvidia or Google versus Microsoft. When you break it down to a share level, it's easier for you to see A versus B. Okay, and when we do that, their free cash flow per share is $5.42. Just like their revenue, just like their earnings per share, it's growing up and to the right consistently, reliably, year after year. That is amazing. The next thing that we want to evaluate is the strength of their balance sheet. As Jamie Dimon said, you want a fortress balance sheet. That way you can withstand setbacks, punches, and someone putting you into a headlock. Because if your balance sheet sucks, dude, it doesn't matter how high quality you think your company is, they are going to go belly up when the times get tough. So without a strong, durable balance sheet, do not touch that company. That's not financial advice. I'm just trying to look out for you. Avoid companies that have way too much debt and not enough cash flow. Avoid companies that are drowning in loans and yet they don't generate a profit. These are lessons that the slide deck that's up on the Patreon go over slide after slide because I think it's that freaking important. Yes, when we look at their cash and cash equivalents, the equivalence portion is anything that's highly liquid. So like CDs, certificate of deposits, treasury bills, high yield accounts, money market funds, stuff that generates money from your cash being deposited into it. Yes, as of like 2021, it was $139 billion and it's slowly been decreasing, and that's because they're increasing their CapEx right now to build out more data servers. Because I think 2 quarters ago, Google made the transparent call that their servers just can't handle the demand from their users. There's more people that want to use Google Cloud Services, YouTube, and all of their other product offerings, but they don't have the bandwidth to support that. So they're spending a crap ton of capital right now in order to build out more warehouses that have data servers in them so that they can sustain the growth. And that's why their cash and cash equivalents are slowly going down, but they're also spending a crap ton of money on all of the different court cases around the world, including Europe, Asia, North America. Dude, every government around the world has it out for Google. Kind of sucks, but we're still talking about $95.1 billion of cash on hand. Are you freaking kidding me right now? There's companies listed on the stock market right now that can't even generate $95 billion of revenue. But Google, Alphabet, they have $95 billion of cash in the reserves, in their wallet, in their vaults. That's beautiful. So what I like to do is I like to compare that cash number to their total debt. When you take into account everything that's due the next year, everything that's due the next 5 years, but also baking in their long-term debt, stuff that's due 20 years from now. When you combine all of that together, that gives you the total debt. So right now on paper, Google has $41.6 billion of debt. That's how much they're leveraged. That's a lot, which kind of makes my wife's student loans pale in comparison with her hundreds of thousands of dollars in comparison to freaking Google's. Dude, that's wild. So after you take all of the cash that Google has to pay off their debts, what's left over? Do they even have cash left over? That's one way that you can decide whether or not a company is cash heavy. If they can afford to pay off all of the loans on their books and they still have cash left over, their balance sheet to me, that's one metric. Looks fine, looks great, is spectacular. And in the case of Google, the amount of cash left over after paying off all their loans is $53.4 billion. Dude, I think they're in a pretty good position. Yes, in hindsight, in comparison to like 2021, they had $111 billion of cash left over after paying off everything. And in 2020, also $108 billion. But I would argue $53.4 billion is still a pretty good position to be in, considering their future growth and the catalysts that are baked into Waymo, the Moonshot Factory, and all of their other bets and endeavors that they don't really talk about. I think everyone focuses on the Google search and YouTube, but everyone always forgets that they're about to have one of the biggest robo-taxi companies operating in the world, alongside with Tesla. Dude, when I think about Google, it's a dividend compounder with cheese. Are you starting to understand what I mean by when I say that? And when we jump on over to take a look at their metrics, it just gets better and better. When we break down the revenue by segment, just look at the growth of it for every line of business. This is beautiful. And I really want to emphasize this point because people say, oh, the Google search line of business is doomed, it's dying, it's decaying. But friends and family, the facts would say otherwise, because as we scroll down and look at the revenue broken down by the segment, take a look at Google search. It is growing year over year, quarter over quarter, I guess in this example, by 10%, by 13%, 13%. You tell me, does that look like their Google search line of business is struggling? If it were to have dropped to like 1% or 2% growth year over year, then I'd be like, okay, that case is plausible. I think they are losing their Google search. But this, to me, friends and family, looks pretty darn impressive. And it gets even better because when you look at their other business segments like the Google Cloud, just look at the growth of it quarter over quarter. Or their Google subscriptions for YouTube Premium and everything else. Beautiful. YouTube ads, dude, YouTube, y'all gotta pay me more. For a company that generated $38 billion in the past 90 days, you could afford to give me a little more. Please. Are you starting to see eye to eye with me as to why I put so much money into Google while everyone else was saying they were doomed? Their metrics and their numbers just scream that they're high quality. But it gets even better because even though they're considered a tech growth stock, they also pay a dividend. No, it's not juicy, but I'll take it. Their dividend yield is 0.3%, and as of right now, their dividend payout is 84 cents, but previously it was 80 cents. So that's a growth of about 5% year over year. When it comes to the growth rate of the dividends, what I like to see is at least 3% or better. If it's flat, yellow flag. If it's negative, red flag. Run away from that company. Because once they start cutting that dividend, it's going to be heartbreak after heartbreak. Case in point, just look at Intel. So the growth rate needs to be better than the rate of inflation. That way my payouts have purchasing power, but also the sustainability of that dividend itself. Because what good is it to have a very high dividend yield that is juicy if it's not sustainable? Meaning that dividend is going to be cut because the company is putting and is allocating way too much capital, money, and resources into funding that dividend. I've seen it before. Sometimes they take on loans in order to pay the dividend. It is absolutely crazy. It should never get to that point. The dividends itself, in an accounting perspective, are paid from the retained earnings, but they're actually paid through cash flow. So if they're making enough cash, then they're able to afford that dividend. And on a GAAP principle, it's depicted by the earnings per share. And that's why it's so important to see that the company is profitable and that their bottom line is increasing. Because if that number is increasing, then they're gonna have the money and the ability and the forecast to increase their dividends as well. If that earnings per share does not increase, nor will their dividends, as a general rule of nipple. Not always, but as a general rule. So when we take into account their dividend payout ratio, that tells us whether or not a dividend is sustainable. 8.9% is so freaking healthy. How do we come up with this number, Amos? So right now, their annual dividend is 84 cents. We're gonna take that number and we're gonna divide it, jump on over to the income statement, by their earnings per share. As of right now, it's $9.39. That gives you a payout ratio that screams this is sustainable. Now, for a dividend compounder with cheese, I usually like to see the dividend payout ratio 75% and below. What does that mean? That means out of their bottom line or their profits, less than 75% of it will be allocated towards the dividend, meaning they still have 25% to pocket to reinvest into the company, to increase their workers' compensation in order to pay off any setbacks or uncertainty that may come in the future. For Google to use less than 10% of their bottom line towards the dividends, are you starting to see why their dividend profile is healthy? It's not juicy, but it's healthy. And before we go any further, a fun fact for you is that I want to give a big shout out to my wife because she got me my first NFL jersey that you see me wearing right now for my upcoming birthday. I'm a pretty simple guy. I don't really need much in order to be happy. But for my wife to have gotten me my dream gift, I mean, look at the back, right? It says fan because Seattle Seahawks, we refer to ourselves as the 12th man, and we put fan on the back. No, it's not my last name. It could be mistaken for that. I do know somebody, a Chinese dude, one of my friends, his last name is Fan. I just can't believe that I was able to reach this age, because I remember in my mid-20s when I was struggling with my mental health, dude, I didn't think that I was gonna reach my mid-30s. Because at the time, dude, I was so devastated and I was so negative. It's crazy to see where life has taken me since that dark point. I'm so glad that I didn't give up, because I think my life right now, I'm pretty happy. I don't have much, I'm not rich, but I get to do what I love every single day, which is to create content on YouTube on a topic that I'm absolutely passionate about. And as you can see, yes, it looks like I'm swimming in the jersey because yes, it is a little big on me. I think it's also a testimony to how much weight I've lost, because I used to be a bodybuilder and my frame was a lot bigger. However, I stopped pumping the iron, and now I do calisthenics. I go running every day. I do my push-ups, sit-ups, and pull-ups. So the frame size is decreasing, but I think I'm still pretty strong, I guess, relatively. All that to say, before you start making fun of me and saying, oh, you look like you're swimming in your dad's clothes, please realize that this is an XL. I usually wear a medium. Sometimes I size up to a large. This is an XL. All right, that's why it's so freaking big, but I still love it. It's from my wife. I don't care if it's too big on me. I'm gonna wear it and take care of it, and I'll be wearing it every weekend in which the Seahawks play. Dude, we're about to whoop some booty to the 49ers this weekend, I'll tell you that right now. But continuing on with defining a dividend compounder with cheese through the example of Google, it's not enough just to have good metrics, numbers, and fundamentals. You also need to perform well in the stock market, because your money has to what? Compound, right? Nobody wants to invest into something where it just sits still and it's flat. Like, you gotta get a stick and poke it. Like, are you gonna do something? Are you gonna move? Nobody likes a flat or an eroding investment. We wanna see it growing. So with that in mind, what you see on your screen right now, I'm on financecharts.com, and we're taking a look at the adjusted stock price total return. It takes into account the share price appreciation plus the dividends paid out. The past 1 year, your ROI, your total return is 49.2%. Friends and family, that's a compounder. If we zoom out 5 years, almost 200%. If we zoom out 10 years, 643%. Your money would have 7x'd by investing into Google. And if we're feeling ourselves with one too many pina coladas, if we do 20 years, then we're talking about 3,153% ROI with Google. And I want to compare them to the S&P 500, which is otherwise known as the benchmark, the standard, the market. You usually want to invest into something that outperforms, quote unquote, the market. Otherwise, just put your money into VU or SPY if you can't beat the market. Their 20-year CAGR, which is the compound annual growth rate when you break down their ROI into year over year, 19%. In comparison, the exact same time period, the S&P 500, 10.6%. Google puts the S&P 500 into an armbar and just snaps their shoulder. It is an amazing cash flow machine. So by all regards, friends and family, that's what a dividend compounder with cheese looks like. And you might be like, what's the point about the cheese, man? Let me tell you, as I wrote in my YouTube biography, the cheese is the X factor, their economic moat, their competitive advantage, their brands, or if they're best in class for their sector. Those things aren't really listed on the balance sheet and in the income statement through numbers and data, but it's an intangible that can be felt through the growth of their numbers, because they're taking away market share from their rivals, peers, and competitors. And unless you woke up on the wrong side of the bed, or you're cranky, or you hate me, you would probably agree with me when I say that Google is the definition of a dividend compounder with cheese. Beautiful numbers, beautiful performance, and a healthy, sustainable dividend profile. So what you see on your screen right now is the compounder chart. So in comparison to all of the other businesses that we analyze on this YouTube channel in the past like 3 months or so, Google, as you can see, is all the way to the left in the certified compounder category. Previously, Oshkosh Corporation was there, but if we throw Google into the mix, a part of the Mag 7, then Google comes out on top. What you see on the right side, the CAGR graveyard, these are companies where your money, your capital, not the wisest place to put into, because your money is not necessarily going to compound. And that's why at the top I wrote, I'm pretty bearish towards them. But with Google, Yeah, and here's another friendly reminder to go check out my videos, my deep dives into United Health Group. And I also want to say this, in comparison to their peers and rivals in the Mag 7, the Magnificent 7, which is responsible for making the market move, Nvidia, Microsoft, Amazon, Tesla, Apple, Google, I still think they're the most undervalued in that bunch. By buying into them right now, they're a little high, but they're still undervalued in comparison to their peers. And I say that objectively because Microsoft's current trading multiple, also known as the PE ratio, the price to earnings, their stock price divided by their earnings per share, is at 37. And for Tesla, it's around 200. Whereas Google, it's still around like 20 something, right? So I'm a pretty happy camper when it comes to Google. And I want to say this before you leave me. If you invest into companies with fundamentals and metrics like Google's, in the long run, you're going to outperform the stock market. Because if the company in question is high quality with superior, excellent numbers and metrics, that increases the probability that you're going to succeed. Now, if you invest into something that is unprofitable, does not have free cash flow, has a crap ton of debt, their revenue is inconsistent, the probability of you losing is a lot higher. Does that make sense? But I understand you because when you think about psychology, I think the difficult and the hard part about investing in the stock market is when you see those crappy companies on sale, you feel like you're getting a good deal by buying into them, but you gotta resist their urge. And I think that's really hard because usually a low quality crappy business sells off because they're trash. They're being priced accordingly to their metrics, fundamentals, and their eroding growth, not because it's on sale. So don't confuse the two. With Google, they were definitely on sale. High quality by all regards, it's just they were suppressed by the regulatory probing. Whereas if you see a low quality company on sale, you gotta look at their numbers and you gotta listen to their earnings calls to see what's the guidance, what's the outlook, what's the forecast, what's their future looking like. If it's tough, if it's rough, if it's ugly, dude, do yourself a favor and stay away from them. That's not financial advice, but it would behoove of you if you want to do well in the stock market. So me personally, with my investing strategy, philosophy, and style, what you see on your screen right now is my 1 year total return in comparison to the S&P 500. 20% versus 15%. And I'm not doing this to boast or to show off, but rather to portray that it's not impossible to beat the market like a lot of these bogglehead ETF investors say it is. I was like, oh, it's so hard to beat the market. You might as well only do VU and call it a day. Like, I understand the logic. And actually, I agree with them. For 99% of the people out here that don't have the time to do deep dives or to research individual companies, you might be better off of getting a modest gain through an S&P 500 ETF. But if you're anything like me and you like researching, analyzing, and looking into stocks, I personally have beat the S&P 500 almost every single year by investing into dividend compounders with cheese. So my question to you is, who do you think is a dividend compounder with cheese? Let me know, because if I'm feeling it that day and I read your comment, I might do an analysis video of that said company. With that said, I want to leave you with this. Imagine that you're reading a book with no way to turn back the page. After you finish reading a page and you turn it, you can't go back. With that in mind, how carefully would you read that book? That, my friends and family, is the book of life that you're on right now. But more importantly, just like what happened 5 or even 15 years ago, dude, you can't turn back the time. You can only change in your ways and in your behavior and learn from your mistakes and to live out your apology and to be a better human. So when you think about the people and the relationships that are in your life right now, cherish, be present, be a good human being while you can, because tomorrow is not guaranteed, dude. Stop putting it off. Mend and repair your relationships and be a good human, please. And the crazy thing is, no matter how difficult or sad your life has been so far, the next pages to come, dude, anything is a possibility. It could go up from now. The redemption chapter is to come. The comeback story is yours for you to be a better husband, to be a better father, to be a better friend, to be a better neighbor. Just something to think about. I'll talk to you guys next time. Stay safe. Good luck in the stock market. Peace.